200k, 20, 10, the donation is accepted because I think enough, right? Enough, right? It's because it's 270k, correct or not? Here is 50 plus 40 plus 20 will be 10, huh? Okay. 110. Now, before I go on, there's a bit of trickiness in this question. I forgot. This question very tricky, a bit lah, you know. Why is it a bit tricky? No. No. The trick is there. There's a small trick hidden inside the question. You see, you could surrender a certain amount of income, yes or not? But there is a cap for this one. Because you got loss brought forward, what? Are you clear? This is not 90k. This is not 90k. Sorry, that one is a bit tricky. Why is it not 90k? Because here got loss brought forward how much? Loss brought forward of 87k. The loss brought forward can apply here first or not? Yes, right? Can apply against the 60k, correct or not? This is where it is a bit tricky. So, the loss actually is 200k. Can surrender. Loss brought forward will be how much? How much is the loss brought forward? Well, you used up 60, so 27 plus. You understand what's going on or don't understand what's going on? No, you see, the first year there's a loss brought forward. Second year, the 87 will be used up against the 60. Can you understand or not? But hold on. But this 200k must drop against the 50, right? Sorry, this one also cannot. I know, I remember I made this question very messy myself. I purposely go kill myself on this one. No, because you know why? This 200k will then offset against the 50. Clear? Not clear? Can, because the 60 will come from last year. 200k will offset against the 50 first. So 150 only you can use as a loss. Okay, are we okay in this part? Can, of which you can surrender how much? 70%. Giving you? How much? Okay, how much is the loss brought forward? So loss brought forward is 45 from here plus 20 from last year. I think, is it 65? No, not 20, sorry. 27 plus with, how much? 72, Okay, done. This was the torturous question. Looks simple only, right? Sure die. Okay, let me go through one more time. Okay. Number one, first year you made 300k loss, 50k loss, correct? Okay. Rental is 60, so you had a total loss of 290k. Okay, done. You surrendered 203. Can surrender up to 203, but I don't think you can surrender up to 203. Can the other party can take up the 203, yes or not? Okay, so the other party takes up 203. You still have 87 in your hand, yes or not? Carry forward. Carry forward loss, business loss can be offset against business sources. Remember, can be offset against business sources. So in this case, second year, 200k loss, current year loss. This is the one that you can probably surrender. 60k current year profit, adjusted income, which you can kind of use your prior year loss to offset. Are you okay now? You have 87 in hand, what? So 87 minus 60 left 27. Are you okay? 27, keep one side. Okay. Now this 50k loss, you can use current year, must use, there's no cannot use, must use the current year loss relief. Must use. So it dropped to 150k already. Are you okay in the logic there? Can, So you have to think it through properly. Remember, it looks like a small question, but I can trap you very fast, because you might forget that there are steps. Then the 150k, you can surrender 70% of that. So you can surrender 105. You still have a loss brought forward of 72k for next year. Okay, can.
Sorry, the loss brought forward, if we want to offset with the current year
Can profit. Can.
Do we consider or concern on the brought forward loss is from business one or business
No,
two?
no need. Aggregated. It's a relief available. Brought forward loss goes against business losses. It's not ring fence. It's not ring fence. It's not ring fence, It's relief available. Remember, it's a relief available for business source. First year is available for aggregate all. After that is available for all business source. Yes. No. As long as business, no need to ring fence to. It doesn't ring fence. There is no ring fencing for the loss. This loss doesn't have a ring fence. Just remember, as long as it's a business loss, you can apply it. No, the rental income. It's the source. Business source, rental income source is two different source. Are you okay in the logic now? Current year. That's the reason why you must know. Okay, repeat. You need to know the first page. You really need to know your first page. This page. You see where is current year loss sitting. See, less previous year's business loss is here. See where current year loss is sitting. See the location. Previous year business loss is only at business level. This one is current year loss aggregate level, which includes all the other one, rent, interest, all here. So the 2 point, you must be very clear. If you're not very clear, that's where the confusion comes up. Okay, are you clear in the junction where that one goes and this one goes? No, the two things. That's why I also almost got caught with this question. Very dangerous question. Be careful, small question like this, very dangerous. Okay, are we okay in this part? So how much is the B? Okay, now B, $2014 is going to be, I want to go back again. Where am I? Page number, how much is B's one? Have you calculated? Quickly calculate for B. First year, 200 plus 20 plus 50 minus 20 become 270 minus 20 minus 203. What do you get? Follow, Now I'm not doing the statement, you just need to know how it's done already, Okay? What do you get? 47. Okay, fine. B, this one's going to be, well, this one's flat out. 50, 40, 20 is going to be 110 minus of 105. Okay, done. Clear? Not clear. I just had one question. How now? In 2000? How? So A will be, A loss carry forward will be Carry forward, not brought forward. A loss carry forward will be how much? B are we okay in this part? Can Okay, when I give exam objective question, can I give it just like this? That means I just ask you to tell me the just for 2015, tell me the loss carry forward. That's all. Are you okay? Enough, I test you one thing, everything also you have to know. Why 97? Because you can only transfer how much? 80. Although you got 105 to transfer, you cannot transfer 105. Are we okay now? Can? Okay, clear? Not clear? Can I move on? I know, this is a bit scary, but this is how scary it can get. No, you can only transfer 80 word. I said the question is, if B only had 80 in this year, instead of 110, here got 80 only. If got 80 only, then A can only transfer 80. If A transfer 80, the loss carry forward become, tambah back the 25. Can? Okay, can I move on? Any questions there? Okay. Next one we're coming to. Okay. That's the complexity you can get. That small question is the complexity you can get. Follow. Get ready for that complexity lah. Okay. Now, don't jump. You jump in very fast, what will happen? Die. Very fast to die, this one. Alright? You want to do all this, I repeat again, calculation for the tax paper, don't jump in. Do it last. My suggestion is do calculations last. That was the suggestion I gave last semester for all the students. That's why most of them got through. Most of them didn't do calculation first. They went and did the written part first. Because over time, we found out that those who do calculation tend to fail because they get messed up with the calculation, their heart fall off. After that, they know they got it wrong already. After halfway calculating, you know they are wrong already. So then after they calculate wrongly, their motivation drop. So that's why I said this last semester I told everybody, don't touch calculation first. No matter what calculation, do last. Make sense? Majority did get through last semester. I'm also surprised about 70% pass. So it's kind of a good result lah. I think the strategy works lah. Alright? And also the way to analyze question. I think I teach you that one already, right? The 5 steps. The two of things combined together seems to be working. Okay? Right, so let's look at this part. Residual asset, residual profit test. Anti-avoidance provision designed to prevent companies from being structured in such a way that any losses surrendered are merely paper losses and not losses which are actually borne by the group. Okay, this is, remember, anti-avoidance. The candidates are expected to have awareness of this provision, but it will not be tested in detail. Awareness. Okay, expected to have awareness. Okay. The second level, the test must be applied to any company which owns 70% of paid up ordinary share capital of a surrendering company or to claimant company for the purpose of related company test. The relationship will fail unless owning company is beneficially entitled to 70% of the residual profit of the other company which are available for distribution to other equity holders and residual asset of the other company. So you must own 70% of the asset and 70% of the profits. Then only it's valid. Okay. Residual profit. What is residual profit? Okay, this is the calculation. Okay, residual profit of a surrendering company, a claimant company, after deduction of any dividend, which is fixed amount or fixed rate. So you have to minus out all of this. Okay, remember, fixed dividend. So the word residual profit is not, it's a special term. Just remember, it's a special term for only to determine whether group relief valid or not. Okay. Now, commercial loan would be a borrowing at commercial rate. Generally, a lender in commercial agreement would have the following objectives. They might set out the following things: set out conditions under which it will be obligated to disburse funds, to enable it to monitor borrowers' financial situations and take remedial action, and to provide itself legally enforceable claims. If there is loan agreement between related parties, but that there is no remedial clause in the contract, such loan will be considered non-commercial loan. Okay, so there are two types of loan you need to know: commercial loan and non-commercial loan. The word commercial loan will have to have this characteristic. Okay, conditions: obligated to disburse funds, enable to monitor performance, provides a legally enforceable claim to funds or access other remedies. Okay. Then, if there is a loan between related parties, no remedial clause, you classify it as non-commercial loan. Okay. Any borrowing that do not fall in the definition of commercial loan would be considered non-commercial loan. Okay. So here you got the accounting profit. Remember PBT. Less fixed dividend, less dividends, percentage of profit before deducting any payments to non-commercial loan creditors, where payments are not subjected to fixed percentage. Then you got residual profit available to equity holders. There is a calculations for this. Okay, and there's also a calculation for residual asset. Let me see whether I can put see this question here. Can you look at this question here? Look at this question. Second level test. Look at this question first. Okay, are you looking at Brooks and Amberhart? Okay, this is for you to understand this idea. Which idea? This one here. Just remember, residual profit. Are we okay? Mark, this is the thing that you need to know for residual profit only. Okay. Brooks and Amberhart has three types of shares. Okay, here you got owned by AB, AC. Okay, can you see there are how many types of owners? There are three owners here, A, B, and C. All right. Okay. Paid up capital so much. Ordinary shares, yes, yes. This one is no. This is yes, yes. This one, look at it. Right to shares and profit based on holding in share capital. Fixed dividend at 10% at nominal value of shares. This one is fixed dividend at 8% plus right to share profit based on holding of the share capital. Got it? Clear? Okay, calculate the entitlement for each of the three companies and determine who is related. Okay, who is related? Okay, the word is related. Calculate for equity holder beneficial entitlement if for residual Brooks, if it makes an accounting profit of 500 after deducting fixed payment of 1,000 commercial loan at 5% from X and a variable payment of 1,000 for non-commercial loan at 3% plus any profit participation which is not fixed from Y. Okay, now let's have a look at this part. First part. Entitlement of each three company and determine who is related. Okay, in terms of finding out relationship, how do you find relationship here? Find the type of capital, yes or not? Okay, and also you do need to calculate the ratio here. So 1,800 shares, calculate the percentage. Here is 1008, right? In terms of ordinary share, it looks like what? This one is fixed dividend, 10% on nominal value of shares. This is type 2 shares. Fixed dividend 8%, right to share. B has how much? $400 and that's it. C is okay. In terms of calculating the percentage of shares, which shares should you be using? Ordinary shares, right or not? Does that make sense? So ordinary share class is this 1008 plus 600, 600, 200. So total ordinary shares is how much? It's going to be what do you get? How much? 2,000? 3,300? 200. Okay. A has how many percentage? 1,008, 600. That's it, right? So it's 2,000 equals to 2004, right? 70%, huh? 2.4. 75%, huh? B has how much? 600 divided by 3002 equals to C is going to be 200 divided by okay, are we okay in this part? Can I? Can? Follow, don't follow. Got it, huh? Can I move on? Okay. Let's move out of this one. I'm going to leave this first aside, okay? I'll come to this later on during revision. Okay. All you need to know is how to calculate this one first. Okay. And all of this I'm going to come to when I do revision later on. Alright? Okay. We're done with this part. Okay. The other part you need to know is about penalty for incorrect information. Where a loss surrendered has resulted in wrong loss set off for claimant company, Director General has power to make an assessment of additional, make a note, has power to make assessment or additional assessment the year which incorrect set off is discovered, or within following 6 years. Make a note, within 6 years. They have a 6-year limit here. All right. Okay. This would be any assessment on the claimant company to make good a loss of tax which is likely to lead to penalties. Okay. Now, a penalty can also be imposed on surrendering company where the company has given incorrect information. So there can be a penalty on the surrendering company if they gave wrong information in its annual tax return about the amount of adjusted loss they have. Okay. The amount of penalty prescribed is equal to the amount of tax the claimant company could have underpaid because of this. So remember, penalty could be based on the tax underpayment. Okay. Surrendering company has a right to appeal this imposition within 30 days of issue of penalty. Okay, that's that part about incorrect. This is the legal part. So the examiner has tested this part on a regular basis. Okay. Okay. This part, if more than one company surrendering or claiming, there is a possibility more than one company can surrender and claim. This happened earlier on, remember? One company was surrendering, many company was claiming. Clear? Or there could be another situation where one company is claiming, 2-3 companies is surrendering. Can you understand that logic? Okay. So a surrendering company can surrender its adjusted loss to one or more related companies. Company has to surrender amount adjusted loss to be fully set off the amount of defined aggregate income of the first claimant company. Any balance of loss can be then surrendered to second claimant company and so forth on order of priority. Are you clear or not? Follow priority. A claimant company can also claim adjusted loss from one or more related companies. Adjusted loss surrendered by the first surrendering company shall be fully deducted from the defined aggregate income before adjusted loss of the second. So there is an order of priority, where you set off and who you claim first. Remember, who you claim first. It means claim fully from the first company. You cannot claim half and then leave some behind. You cannot do that. The rule here, 100% claim, then the next one and the next one. Are we okay in this part? Okay. So if I go back to this question, okay, remember I went back to the first question here. This question, the loss surrender was directed by DGIR, yes or not? If the loss was not directed by DGIR, who do you think will be the first one to get the loss? A. You first fully settle A, then you might settle C. The balance will go to B. Are you okay in this part? If you follow that order, there's only a very little difference. Not so much difference. Here will become 0, here will become 0, here will be the balance. Okay. Are you okay in this logic? Can, huh? Right. Surrender claim has to follow order. Both surrendering company and claimant company has to ascertain the order of priority by making irrevocable election in the prescribed form. So now the requirement is they must be told when they make the election. Make a note. This is quite important. You don't need to remember the forms. Just remember, when they make the irrevocable election, they must set priority of surrender and claim. They must. No, for that year only. For that year, each year by year. Yes, they choose. They're like, this year we make the election. Then when you make the election, you have to tell, go here, go here, go here. Finish. Next year you make another election. Okay. Every year. No, cannot. That one was special case. That one was because the question said that. Remember, I think that one was DGIR indicated. That one. There. The Director General has decided. Are you clear now? Pay attention, This one a special case. Prorating based by DGR. The rule is fully used, then the next one and the next one. Are you okay in this part? Okay, are you clear in the concept of prorating? Yes, no. There is no prorating unless the DGR intervenes only. Okay. So, where are we now? If a loss cannot be effected in accordance to the order of priority specified by any surrendering or claimant, the amount is adjusted and surrendered shall be dealt there. Can see not? It will be dealt according to how the DGIR might ascertain it. That's the one you did first time. Follow the priority. Unless you cannot follow the priority, then you trigger, the DG might have to indicate how to do it. Okay. The amount of adjusted loss surrender shall be disregarded for purpose of ascertaining aggregate income of surrendering company. Okay. The amount of loss that can be transferred is subject to defined aggregate income of claimant company. So remember the question you asked me first time? How much can you claim? Yes or not? Whatever balance can be left, no, it's limited. Can you see not? It's subject to defined aggregate income. Where an adjusted loss is more than the defined aggregate income of claimant company, the excess will be retained by surrendering company as unabsorbed loss, which I already showed you earlier on. Yes or not? Okay. This unabsorbed loss can be used to offset statutory income of surrendering company in subsequent years. If surrendering company mistakenly surrendered adjusted loss to claimant company, incurring a loss and not having a defined aggregate income, the surrender loss cannot be transferred to another claimant company, but must be returned. This is a quite important rule. Mark this rule. Put a big star on it. I think the examiner might want to test this rule. Yeah. What is this rule? What is this rule? It's a very funny rule. If I surrender to you and you got lost, but she got profit, we are all related companies. She got profit, but I accidentally surrendered to the wrong company. Too bad, burn. Come back. You cannot use because you got lost what? So it'll bounce back to me, finish the end. Cannot transfer back. Cannot. See. End of the year, you make the election. You make a mistake, your problem. It's like a penalty lah. It's like a penalty. They just say, sorry, cannot go and revert back. Loss. I transferred to her, but she also got 50 loss. She got 5,000 profit. No, it's still a loss. It's my loss. I can still carry forward loss. For a burn, the loss relief burn. The group loss relief loss. That one only burn. Not the loss is burn. The loss is still, it just come back to my hand. Okay, are you clear or not? Yes. Okay, are you clear on this rule? So, Mark, I think this one the examiner might want to test. Because the examiner will be like, they made a mistake and transferred to the wrong company. Then you must say, once transferred, it revert back to the owner, full stop. Okay. Any questions there? And it looks evil, right? The rule looks evil. She shouldn't make the irrevocable election, You went and transfer there. You didn't know she made a loss. That's your problem. Okay, are we okay in this part? Can I move on? Okay. Okay, before I go on. Okay, that's about this one. I'm now moving on to the next issue. I'm just going to cover something called unit trust and REIT first. Before I go to unit trust and REIT, can you look at this question here? Okay, here. Question number 192. I will visit back group relief one more time. Okay? During revision time. For now, you just get the basic knowledge first. Okay. Have a look at this part. Okay, residual profit calculation. Okay, Ivana Sdn Bhd has 75% ordinary shares of the company. Mark has 20%. Donald has 5%. Then you got, okay, Spence Sdn Bhd has the following capital structure. Spence Sdn Bhd has two loans, a commercial loan from Putin Sdn Bhd, 2000 at 5%, and non-commercial loan from Najib Sdn Bhd, brother of Najib, right now, for 4,000 with an interest of 5% and right to share profit based on value of the loan. Evaluate if Ivana is a related company for the purpose of group relief qualification if the profit of the year of Pence is 986. Okay, pay attention. The profit is 986. If the profit is 986, okay. Now, what happens in this case? First part you have to know is what? Evaluation. Profit is how much? Can? Are you okay, Nisman? To calculate residual profit, this is the way you calculate it. Profit here is 986, right? Interest in this case is going to be I think a preference share dividend is going to be okay. Can? Any questions there? Follow, Okay, Okay, I will stop there for a short break. Right, when we look at incentives, where do incentives fall? Okay, there are a few types of incentives that might come out. Pioneer incentive is full or partial exemption of statutory income. Then there's investment tax allowance and reinvestment allowance, which are additional relief for qualifying capital expenditure. So this one, too similar. Does that make sense? This one too similar. Pioneer relief, full or partial exemption of statutory income. Got it? There are other reliefs which are linked to this. You might get the export relief also. Just make a note. They are also kind of a full, it gives some relief based on your statutory income. Clear? Okay. So basically you can break down relief into two types. One that's based on the statutory income that you have earned, or one that's based on the, repeat that, one that's based on the statutory income you have earned, or one that's based on the expenditure on capital equipment. Clear? There is generally two types. Can, cannot. Okay, so let's keep it simple. Incentives are normally are you clear on the two types? There is income base. Okay, are you okay in this basic incentives? Yes, no. First, you have to understand the base of incentive first. Follow? Yeah, that's all. That's the general idea of incentive first. Are you clear or not? Got it? You need to understand the general idea of incentive. Fair enough? Are you clear on these two ideas of incentive first? Yes, no? Now, based on this, we have a few types of incentives. Okay, let's go through one by one. The first one, let's go through, pioneer status. Okay. Generally, it's possible for a company to be granted pioneer status by media for multiple promoted, notice this word, multiple promoted products or promoted activities with their respective TRPs. TRP stands for the tax relief period. Okay, so many tax relief period can start off, start, close. It's not necessary everything must be the same year. Commencing and ending at different dates. So pioneer status could be like running for many different products and services. Production day is significant as it marks the commencement of the pioneer status. So you need to know what is production day. This is an important term. TRP subsists of exactly 5 years from production day. Got it? 5 years. Separate account must be kept for each pioneer business district from the rest of the business activity. This is very important. Separate account must be kept. Now, remember, your examiner is going to ask you all of this. Don't take it for granted. A lot of people in studying tax seem to focus too much on the computational aspect. Remember, it is not about the computational aspect anymore. The paper is not about that only. It's about compliance. So compliance means the examiner will expect you to know what are the advice you give to client to make sure they comply properly. Like you got pioneer status, you must tell, hey, you must keep separate account for this business or not. IRB will not accept it. Clear? Not clear? So that's like compliance advice. So remember this word, compliance advice, computation. Okay? Okay. The next one you got is pioneer company is deemed to have 3 periods in their life cycle: pre-pioneer, pioneer, post-pioneer. So those are the stages of the life. Pioneer business is deemed to have permanently ceased at the end of the period, the tax relief period. A new business, post-pioneer business, is deemed to have commenced on the day following the end of TRP. So notice one, deemed. There's some deeming going on. Deemed to have commenced after that date. Okay. This has implication for capital allowance. During the TRP, company which has been granted the standard normal PS, 70% of statutory income, the pioneer income, after deduction of various losses, is exempted. Okay. The balance 30% is leapfrog to total income stage to form part of the whole total income of the pioneer company. So remember, what happens is, when you are in the pioneer period, 70% exempted, 30% straight go to total income, skip everything else. Are you clear? So we call it leapfrog. This means 30% is quarantined for tax. Approved donations and other deductions are from the aggregate income are bypassed. Pay attention. It goes straight to total income. Doesn't even go to aggregate income, you know. Okay, does that make sense or not? Because your donations are based on your AI, yes or not? This one go to TI straight, so bypass that one. Clear? Not clear? Understand the logic there? Okay, this is so quite critical to know where this one leapfrog. Okay, when I go leapfrog, I better go back here to show you. So it leapfrog from where to where? See, aggregate income is here, you know. That means you have your statutory income here. Then what happened? Can see not? 70% exempted. 30% goes straight down here. Here all cannot apply, you know. Okay, do you understand that rule? So you must know the jump. From here, 70% go to relief, 30% straight down. Simple step. There's nothing complicated to this. Are you clear or not clear? Can? But there is special rules for the allowances part. Okay, we'll look at the allowances part. So let's go back to incentive. That's my incentive page number what? Okay. Okay, so back to this. The calculation is something like this. You got adjusted income, you got capital allowance, you got statutory income. You take out a tax exemption here. Does that make sense? Okay. After you have tax exemption, sometimes you can get full exemptions, usually partial exemption. Are you clear or not? Then, remember, balance 30% is deemed to be part of total income straight. Jump straight to total income. Alright? Jump to G straight. Okay. Then, no deduction for business loss for current year brought forward, no deductions for approved donations. Then here there's special situation, non-pioneer loss. Adjusted loss from business manufacturing product which is not promoted. Okay. Adjusted loss from business manufacturing product which is promoted activity. So the losses got special treatment. The losses, business loss treatment also got issue. Any loss from the pioneer cannot be used as a normal loss. The treatment of a pioneer loss is different. Are you clear? This is the first part you have to be understanding. Other normal losses are okay, right? Now, then you got exemptions down here, and you can pay out what do you call? Exempted dividends. So eligibility, it must be for promoted activity or promoted product. Remember, what is a promoted activity? Could be manufacturing, agriculture, integrated agriculture, hotel, tourism, R&D. So the R&D is the one that came out last sitting already. Okay. ICT, multimedia supercorridor in the relocation to promoted area. Scope can be company, can be sole proprietor, can be partnership, association or cooperative. Application for pioneer status. If successful, pioneer cert must be requested within 24 months. Tax relief period begins on its production day. The first day you start doing the activity. Clear? Okay. And continue for a period of 5 years. Exemption could be 100%. Usually 70% for 5 years. Got it? Okay. Special deduction of 100% of statutory income, exempt for additional 5 years for resident company incorporated in Malaysia. It's possible to get special deductions. Now, the qualifying capital expenditure, these are all allowed for the pioneer. You can claim capital allowance on all this. Okay. Manufacturing, the factory, plant, machinery, your hotel, you can claim for the hotel, building, plant and machinery. Tourism, you can claim for clearing of land, planting trees, roads, getting birds, animals, building living accommodations, and agriculture, same thing. Alright? Don't worry, your examiner is not going to ask you this. These are all not ideas the examiner asks, but she will ask you certain compliance issue. Okay. Mechanics, 50 to 100% of QCE, set off against 70 to 100%. Basis. Period not exceeding 1 year from date of pioneer commencement. So, successive period for 1 year thereafter. Period not exceeding 1 year to the date when pioneer business ends. So, remember, there is a point of basis period for pioneer is different from the basis period for the normal business. You have that 5 years, right? It starts when you start your production day. Clear? The business of pioneer shall deem to have ceased permanently at the end of tax relief period, a new business deemed to start. Okay, so there are 3 stages. Are you clear or not? These are the 3 stages. Pre-pioneer business, pioneer, and then post-pioneer. So capital allowance claim is usual. Unused is carried forward and used in pioneer period. Transfer the asset residual expenditure to pioneer business. So notice you will transfer as if you're transferring to new business. Does that make sense? So the residual expenditure is transferred. Claim as usual, no choice for not claiming, must claim. Then at the end of this, you transfer back again to post-pioneer business. Clear? So technically the asset residual keeps transferring. Does that make sense? Okay. Pioneer loss set off against pioneer income cannot be used against non-pioneer source. So ring fence the loss. Make a note, ring fence the loss. Whereas here, normal can carry forward as usual. Tax exempt income will be available. Other losses must apply against pioneer income first. Okay. One of the areas that the examiner may want to test is the capital allowance treatment. Okay. So, there are rules for capital allowance. I'm going to just show it to you how it's done. Have a look at this question. ABC, remember, was granted pioneer of its promoted product on 1 May 2013. Okay. The manufacturing business commenced on 1 November 2013. The production day for pioneer status purpose was ascertained to be 1 September 2014. ABC closes its accounts annually to 31st December. It incurred the following QCE, okay, during this year. Okay, now pay attention. You got the date and the QCE given here already, alright? Okay. Required. State the 3 periods involved. Calculate the RE and CA. Calculate the deductions made for CA. So let's talk about the first thing. What are the periods involved? Pre, pre-pioneer is right. Are we okay at this part? Yes, no. No, there. Not 1 year. What? First, is you see, you start the pioneer here. Crossover already. Your business for pioneer started here already. It start here, but it starts from 1 September to 31st December. Follow the basis. Follow the basis period here. Got it? Okay. Are we clear on the basis? Okay. The next thing is the capital allowance. If I'm going to capital allowance, pay attention. Capital allowance, the expenditure. When is the QCE incurred? Okay, you look at the QCE incurred. The first one, see this one, 10 July 2013, 15 December 2013, correct? 15 December is supposed to be in the pioneer period or non-pioneer period? Look properly. Can? This one incurred when? Pioneer also, right? 680, right? Go behind. This is the rule that you have to understand. Okay, now I come back to the rule. The rules are here. The rules for Pioneer. CA rules. Okay, let's look at the rule. Where a pre-Pioneer asset is used in Pioneer business, the RE at the end of the basis period immediately at year of assessment, during which CRP commences, is deemed to be RE of commencement. That means transfer across. Are you okay or not? Okay. QCE incurred in the period which date of cessation of pre-Pioneer business fall is deemed to be incurred on the day of commencement of the Pioneer business. So let's look at this part. This one, can you see what has happened? QCE incurred in the period in which date of cessation of, notice that, date of cessation of pre-Pioneer business is deemed to be incurred on the day of commencement of the Pioneer business. So, although it's incurred here, it's assumed to be incurred first day here. Does that make sense? Okay. Next one. Where an asset is used, just remember, where a pre-Pioneer asset is used in a Pioneer business. Where asset in use in Pioneer business continue to be used in post-Pioneer, then you transfer across. Okay. So, where pre-Pioneer as capital allowance cannot be utilized or cannot be utilized in full, such unabsorbed allowances can be set off against income in the Pioneer business. Any unabsorbed Pioneer capital allowance are carried for the following year of assessment during Pioneer period. So, you just carry forward. So, in terms of looking at how it is carried forward, I better show you how it's done. We'll go year by year. So, this one all incurred in 2013. Even though the date it's incurred is, remember, it's incurred in the Pioneer period, right? Not yet. It's not yet incurred in the Pioneer period. Pioneer period only starts in September. Okay. So, this one, these two will fall into the first period. 760, right? Okay. You minus off capital allowance. How much is your capital allowance? Let's assume initial allowance of 20% and 40%, 14. Annual allowance of 14, initial allowance of 20%, so 34%. $258,400. Okay. So you should get how much here? 501 600. Okay, this amount is going to be called Okay. Next one was 2014. When was this incurred? 14 April. 14 April was still here, but deemed incurred here. Got it? So let me explain that 120 now. Are we okay this one? So the basic rule is capital allowance you transfer across at RE. Are you clear now? Whatever incurred on the year of the Pioneer starting, deemed incurred for the Pioneer business. You don't calculate the IAAA for the pre-Pioneer business. That's all. The IA and AA is given to the Pioneer business. This 120,000, the IAAA go to the Pioneer business. Follow, don't follow. Then this 680,000 occurred in the last year, right? During the pioneer period, but it's deemed incurred in the first day of the non-pioneer or post-pioneer business. And the IAAA go to the post-pioneer business. Are you clear on the IAAA who can claim? Any questions there? Follow. Can I move on? Okay, that's called capital allowance rules. Now we go to treatment of losses. The following rules are deducted by reading together section 21A. Okay, so remember there was a loss treatment there, right? Earlier on I put some loss treatment, correct? Okay, the treatment of losses. Pioneer income of a pioneer company is reduced to the extent of any adjusted loss for the basis period for year of assessment in respect of business relating to non-promoted activity or product. Does that make sense? A promoted activity or promoted product which no PS or ITA was granted. Okay, so remember this refers to non-pioneer business current year loss. This means current year non-pioneer loss should be utilized against current year pioneer income first. Can? Next one. This refers to non-pioneer business, but more significantly, it excludes current year pre-pioneer loss. First year of assessment in which TRP commences. That means once you have current year pre-pioneer, once you have this loss, current year pre-pioneer loss, okay? What happens here? This means pre-pioneer loss for the year of assessment which TRP comments cannot be set off against pioneer income. This is quite important rule. This loss therefore is treated as a loss provision under section 44.2 against aggregate income from non-pioneer source. Failing which it is to be carried forward and set off against non-pioneer business income. Okay, you have to remember this rule properly. So in the first year, promoted activity or promoted product for which no PS or ITA was granted. It means this is the pre-pioneer loss. Pre-pioneer loss, treat like normal loss. Okay, repeat. Pre-pioneer loss, treat like normal loss. Okay? Promoted activity or promoted product granted pioneer status or ITA but whose TRP has expired. This refers to unabsorbed pioneer loss brought forward from pioneer business. Okay, are we clear on the three types of losses? Can? Note the following. Okay, there are some rules. This is a set of rules that you have to follow. 70% of the statutory income of pioneer business after deducting capital allowance is used to set off losses from non-pioneer business and then pioneer business, in that order. Okay, what's the meaning of the order? The order means when you have losses, the loss take priority. If you earn, remember, the 70% income, right? The 70% exempt income, you got a loss from other source, you hit that one first. After that, you hit the pioneer business source. Clear? Not clear. That's the rule. Okay. The balance, if any, after setting off the losses is amount exempted, and this amount is credited to exempt account. Okay. The remaining 30% is leapfrog to total income, which means 30% pioneer income cannot be used to absorb current year losses or approved donation. Non-pioneer loss thus utilized against the statutory income of pioneer income in respect of pioneer business shall be disregarded, ignored. That means what? You can't use it anymore. Once you use the loss, it cannot be used anymore. Disregard. That means you can't use it as a current year loss facility, or you cannot even carry forward already. That's the meaning of that sentence. Are you clear or not? Once you use it for the pioneer income, forget about it, burn already. Okay. This means any non-pioneer loss should be first set off against current year pioneer income, and amount of such loss thus utilized is no longer available for set off against current year non-pioneer income. Non-pioneer loss are deducted before deducting pioneer losses. This is an important rule. Just remember, there is a sequence. Any loss income in respect of pioneer business during TRP will be set off against any income from pioneer businesses of the income. So remember, if you have a loss from a pioneer source, you can only offset it against a pioneer source. Can? Okay. Any unabsorbed pioneer loss at the end of the debit shall be carried forward to post-pioneer and set off against statutory income of all businesses. So if you have any loss carry forward, that one will become carry forward loss. Will transfer to become a normal carry forward loss. Can? Okay. Have a look at this one. The following relates to Alan Berhad, a company that's involved in the business of manufacturing multiple products and services in Shah Alam. All figures are in thousands. Okay, now business 1, you got 2018, you got business 2, business 3 is pre-pioneer, business 3 pioneer, then you got business 4 pioneer. So they got 2 pioneer, 1 pre-pioneer, 2 non-pioneer. Okay, are we clear this part? So business 3, you can see two stages. Can you see 2 stages? Do you know why I got 2 stages, right? Pre-pioneer and pioneer got lost. Okay, are you clear this part? Can, So, then you got interest income, then you got donations approved. Unabsorbed non-pioneer loss brought forward, also got 25. Okay, calculate the tax charge for 2018 and 2019 and tax exempt account. Okay, let's calculate this one. So if you calculate this one, how do you calculate this one? Can you calculate the first one? Okay, business 1 has, correct? Business 2 nil, all this is statutory income, SI. Business 3 also nil, all this is. Business 4, what's happening? Got 300, yes, no? How much is the non-pioneer current year loss? $389,400. So the whole thing will be done. Got it? Can, huh? Next, what's going to happen? See this 20, how much is this? Unabsorbed non-pioneer loss. Got it? Clear? Any questions there? This is what we call application of, don't worry about the numbers, I'm just giving it for knowledge only. Can, huh? Any questions there? Can? The focus of this question is to look at this part of the treatment. Remember, your focus is this one. These are the items of focus for this question, alright? We're supposed to focus on the these items. We are looking at loss treatment. I clear now. We want to focus on the loss treatment. We're not worried about capital allowance and all that right now, alright? We're more worried about the loss treatment. How do you treat the losses? Okay, are you clear in this part? Let's go through step by step. Step 1. Whatever current year loss from a normal non-pioneer business, you apply against what? Must first apply against the pioneer income. Remember, that means follow, don't follow? Remember, the rule is apply non-pioneer loss, then apply pioneer loss, correct? Follow, don't follow? Can. Okay. Then you got any unabsorbed losses, that one you can use to all business losses lah, as usual. That's standard. Okay. Then you come down here, once you reach aggregate income, you can use all your current year loss, non-pioneer source, as long as it's after this one. You can see now. You use 210 already here, what? Clear? Follow, don't follow? Understand this part? So the 389 from here, you have to use up 210 here. This 99, you carry forward. How much is it? Still available, yes or not? This non-pioneer 179 come down here already. That's a step of application of the loss. Are you clear now? There's a sequence of application of the loss. You need to know the sequence of application of the loss. Okay? This is expected to come out this time, the loss treatment. The examiner is expected to ask this. Last teaching was more on the capital allowance. She focused on capital allowance a lot. She didn't focus too much on the loss. There was pioneer. Doesn't mean pioneer got so many things to ask. She only asked about more on the capital allowance rather than on the loss. So you be fully aware of the loss treatment this time. Okay? So are we clear on all the losses that I'm highlighting here? Yes, no?
So which means the 210 is already utilizing all the non-pioneer loss, so we can utilize the pioneer loss 99 lah.
If not fully used means then must use the 99 pioneer loss. That's the meaning of that step. Are you okay now? Then you move down here, 389 minus 210, that's the balance here. This is like normal loss lah, against aggregate income. Then the less current year pre-pioneer loss can be used. You still carry forward 22. Alright? Okay. Are we okay in this part? Now I'm going to calculate for this is the leapfrog. You can see this step. This is the leapfrog. Leapfrog. Leapfrog is the step whereby the pioneer income 30% goes straight to the bottom. Are you okay? After donation, after current year loss, everything. Follow, don't follow? Can I move on? Okay, the next thing we're looking at is we'll do the following year. Following year, what's happening? Well, pre-pioneer got 120, 50, here got 70. Everything is making a profit, okay? 500, here's 132, here's 50. Unabsorbed loss finished already. Are you clear now? Got it? Utilize already what? So, item. Okay, this one how much? This one is 70. So you can take 70% lah. Remember? Become 49. Are you clear now? Here is how much? Oh, I think I need another line already lah. Oop. This one got how much? 500, right? 70% is going to become? Are we okay in this part? Follow? Can? There's no current year loss, so forget about it. Then you got donations, huh? Donations how much? 50, yeah? 50, yeah? Don't copy so fast, huh? Can. Follow? Can, cannot. Can? So this one is the leapfrog, huh? You remember the leapfrog, right? Now two businesses must leapfrog. This one come from here. Remember? Two businesses must leapfrog already. Are you okay in this part? Can? Any questions there? Clear, not clear? Can I move on? Right, let's move on. Okay, those are two treatments you're supposed to be aware of. Are you okay now? Repeat that. These are the treatments for Pioneer that you're supposed to be aware of. So actually, the most tricky part about Pioneer is the mathematics of doing those things. Are you clear? There are some maths on the format, and you need to be aware about that. All right. How much is the amount of tax exempt account here? The tax exempt account is going to be 300. Follow? Okay, let's move on to the next one. Next one we're looking at is ITA. Investment tax allowance. Investment tax allowance is quite straightforward. It's not so complicated at all. Nothing as the most complicated calculation is actually Pioneer. Everything else is easy. I repeat again. ITA, RA, I repeat, ITA, RA, export allowance are all straightforward. The most complicated you can get is actually Pioneer. Because the rest are just based on a capital expenditure, not so complex. This one got multiple rules, capital allowance rules, loss rule. Clear? This causes it to be the most dangerous one of all the incentives that you can get. So the examiner hits you with a Pioneer, you must be, a lot of people make careless mistake. Just remember, the rules are easy to understand, but when you go to exams, stress plus pressure plus your memory being a bit weak, You understand or not? And then you know, you see first time also 50, okay, 50. Careless mistake, very easy to do. You'll just forget the rule, you lose marks, lose marks, lose marks. Okay, so pioneer, you need to go back and revise it a bit more. What we just did through, you go back, think about it, okay, remember the rules, you know, this one first, this one here, it's the rules. I can make a dance about it, but then we'll do it later. You know, I only create things whenever I go to special project for ACCA. Okay, that's when I'll start thinking how to memorize things differently. Clear? Like the hand thing I did with you all for section 7, remember? You know that. Still remember this one, right? Yes, no? So those are all memory techniques that you need to think about. Okay, now let's go into this ITA. Adjusted income, you got capital allowance, statutory income, and then ITA. ITA is based on 60% of QCA and can be used to reduce up to 70% of statutory income. Up to 70%. ITA can be carried forward. Okay. General, like Pioneer status, ITA is an incentive measure available only for a promoted product or promoted activity. Okay. It's an alternative to PS but comes in the form of additional relief of 60% of QCE incurred to be set off against 70% of statutory income. QCE of ITA is defined under Section 29 of the Promotion of Investment Act. Okay. You don't worry about all of that. Okay. All you need to know is mechanics a bit on this one. ITA and PS are mutually exclusive. What does that mean? This is a very important word. What does that mean? Get one, cannot get the other one. That's all. Okay. Also, once a promoted product has been granted ITA, the said promoted product cannot qualify for another round of ITA on after the 5-year TRP from the date of which the approval has been taken place. Okay. Once a product has been granted ITA, the promoted product cannot qualify for another round. So, one time only per product. Remember, per product, not per company. You don't go and accidentally say per company, then you got problem. Again, separate accounts must be kept. Okay, now have a look at this part. Cisco Sdn Bhd, which has a year-end service number, granted ITA. Manufactured product from 1st April 2018. QCE and the forecast income for promoted product expected to follow. Set the TRP period, treatment of QCE after this period, and calculate the chargeable income and exempt income. So, how now? When does the TRP run from? From 1 April 2018 till are we okay in this part? Follow, don't follow. Can I? Right. Let's do the simple calculations for this one. So this one quite straightforward. You just have to calculate the what are you supposed to calculate? You got adjusted income, you got capital allowance, and the QCE is income. They already give you capital allowance already. Quite straightforward. Are you clear or not? Got it? So you just have to calculate the QCE. QCE is how much here? This is, hold on, 2nd February 2019, okay. Second February 2019, still okay, within scope, yes or not? Okay. How now to calculate? That's all you have to tell me. Should be quite straightforward. I'm going to put year of assessment. You got 2018. Okay, I let you calculate. This one, I think you should be aware of. Cannot. Can. How many percent is the ITA? 60%, right? So you can calculate the ITA. 2019, 2018, how much is the ITA? The allowances equals to 60% times 36,000, yes or not? 2019, how much is it? 60% times 7,200, right? Okay, I let you figure this out now. Try first. Right, you should have got the number. First one, AI is going to be 3,000. Nil. Oh, 7,000. Okay. This one is 20,000. This one is 30,000. Okay, here ITA nil. ITA amount carry forward is 36. Okay. Then here I think you can use how many percent? 70% is going to be 14,000. So this one become 6,000. The ITA carry forward is going to be 36 plus 7,200. Yes or not? Okay, you did get that right. And here is going to be, yep, and this is 9,000. Are we okay or not okay? And carry forward is going to be it's about get done. Did you get this one? Can. Can I move on? Okay, that's about the basics of ITA. I'm going to go to reinvestment allowance. I think ITA, that's all you need to know. It's not very complicated. The basic rule is the 70% rule or 100%, whichever lower lah. Okay, not? Can? They can still carry forward. Until the allowance is fully utilized. But remember, the 5-year is for you to claim ITA. But the ITA allowance can carry forward as long as you not yet use finish. Okay? Can you remember this part? So that one, make a note about it. Okay? The allowance can be follow. The problem is it must be the same business lah. You cease the business then burn lah. Remember, you cease the business then burn. Clear that one? Can I move on? Your business ceased already, right? If you become dormant, it doesn't mean the company has now ceased its business. The same business, they can still claim back lah. They restart the same business. It's simple rule lah. It's locked to the business. Liquidation gone lah. Can Okay, are we okay in smart? So liquidation, all that, you better try to maximize all the allowances before you try to make as many issues as possible to maximize it. Okay, can I move on? Okay. Now let's go to reinvestment allowance. RA is an incentive provided under Act. Remember, this is under the Act, not under the PIA. This is the difference. One is under the two, PS, and ITA is under the PIA, Promotion of Investment Act. I promote you to make an investment into a certain business. Clear? This one, reinvestment allowance, is under the Income Tax Act. Clear? Not clear? To encourage reinvestment or continued investment by foreign domestic investors, hence rather long 15-year TRP. Got it? So that one 5-year, this one 15-year. Can you remember that lock? 5, 15, Okay. RA shares similarity in ITA and feature. So RA and ITA about the same, don't worry. Okay, it's about the same. Okay. The additional relief for QCE incurred is 60% to be set off against 70% of SI from a business in respect of qualifying project, QP. QP stands for qualifying project. Remember the definitions are all up here. As my definitions. I've already put my no, not here. My definitions are up here. QP, qualifying project. Can Okay. So there we know. RA a bit more tricky because you know why not? Remember the calculations, I don't think you have a problem, alright? The calculations shouldn't be a major problem. So let me just run through the major issues here. Okay. If a company has a view that it fulfills the stipulated requisite, it may claim RA in relevant tax form. There is no requirement to apply, this is very important, there is no requirement to apply for prior approval from the authority. Okay. In the past, there has been a high incidence of DGIR differing interpretation regarding what constitutes qualifying capital expenditure, what part of the factory qualified, and what constitutes manufacturing. Okay. These are three areas your examiner will test you. Remember, this is the three area your examiner will test you because there's a lot of case law on this one. Your examiner doesn't test the case law, but she will always read the case law and then she'll get idea from the case law. Okay. Many cases went to court for judicial determination. The cases were followed by laws being amended and public ruling issued to better reflect DG's interpretation. The situation has now stabilized somewhat. Following features are now applicable. So this is the stable environment right now. The part of factory that qualify for RA is restricted to the portion of the floor area used to place or install the plant or machinery for QP or to store materials, finished good, provided storage is not more than 10% of total area. Can you remember this one? So it's just the factory area that you can claim QP, the QCE for it, qualifying capital expenditure, is where you place the new machine plus where you keep the material finished. And the material storage area cannot exceed 10% of the machine finish. 10% limit. If more than 10%, cannot disqualify. The area cannot be qualified already. You cannot claim that part already. Okay, are you clear on this part now? The factory area lah. Okay. Plant and machinery only include those directly used in manufacturing activity. The asset used after manufacturing activity do not qualify for RA. Okay, does that make sense? This one is a bit tricky. Manufacturing activity. So packaging they may not consider, you know. Clear? Okay. Manufacturing is defined by law. States specifically activities that are included or excluded. Okay, so condition. You must be operating for 36 months. You must have claimed at a company level. So it's a company level, not project level only. Okay, it's a company level. Once you claim a company, the company goes for 15 years. The other one was project to project 5 years. Clear? Okay. Extension of 3 years possible from 2015. If control transfer, only one party can claim the RA. Two parties cannot claim RA on the same asset. Okay. Disposal subject to control transfers. Clawback if disposed within 5 years. That means if you sell the machine within 5 years, you will have to pay back everything. Withdrawal if disposal within 5 years, which includes held for sale, cease to be used or transferred to another. These are the three conditions called clawback will apply. You held for sale, you classify held for sale also equal to clawback. Because held for sale is deemed disposal. Okay. The calculation is the same, nothing different from ITA. Alright? Resident manufacturing company. A resident manufacturing company or person undertaking agricultural project may claim a reinvestment allowance based on the amount of qualifying capital expenditure incurred for purpose of qualifying project. So it must be a manufacturer or agricultural project. So qualifying capital expenditure can be, remember, can be factory, plant or machinery. GST not claimable if entitled to claim input tax. Got it? Qualifying factory capital expenditure. This is the one. Used for manufacturing only. So you spend anything on the factory, only for that you spend for the manufacturing side. Storage cannot exceed 10% of extension. Okay, are you clear on this part? The total factory area that you are going to extend and claim the QCE cannot have more than 10% for storage. Exclude any element used for staff welfare, exclude any element used for R&D. Okay, these two exclusion you must know. This one the examiner might ask specifically. This one itself, the examiner can ask specifically. This one box is one question. Clear? Okay. Relocation. Okay. Relocation of plant to new area may lead to reinvestment allowance being claimed in proportion to floor area used for qualifying project. Okay, this is what happened. Last time you got factory, 3,000 square feet. Now you go to new factory, 5,000 square feet. You can only claim 2,000 square feet. Understand or not? Assuming the 2,000 used for the new project. That's the meaning of that statement. See, proportion, but you can claim the proportion. Let's say you say, no, actually the new factory, half used for this project. Then you can claim half. You understand this part? So you got to be careful with the relocation part. Okay. Qualifying project for manufacturers. Okay, this is MADE. Can see now. MADE, modernization, automation, diversification and expansion. Modernization, you modernize your plant, you automate your plant. Diversification. Now, one of the things the examiner got wrong, last time she went and said backward integration is not part of RA. I argued with her that time. I said it is, under business logic it is. She said no. Then the DGIR said yes it is. Then she just keep quiet. The examiner like, yeah, the DG said like that. Then I said, the DG statement is just a clarification of the law. That means the law is already stated backward integration is part of diversification. Does that make sense? So just be aware, backward integration is now diversification, accepted. Okay. Then you got expansion. Therefore, one of the answers is completely wrong. She misinterpreted the law. Okay. Expansion also is one of the areas. Okay. Now, manufacturing will exclude the following: assembly and installation, packaging, distribution, mixing parts. All of this will be excluded for manufacturing. So be aware, the examiner might test you whether they are manufacturing or not. And you might have to explain, this is manufacturing, this is not manufacturing. So that one is principle, not, you don't need to memorize anything. Are you clear or not? This area is all principle based, not you are memorizing rules. Pioneer, you remembered rules. Are you clear the difference? In Pioneer, you had a lot of rules to remember. RA is more principle based. Is it modernization? Discuss. Not modernization. Is it automation? Not. Can you claim or not? Okay. Activities excluded. These are certain activities that are excluded from RA. Ice making is not included. Herbs dealing, cement, doing boxing. Not boxing people. This is boxing the boxes. Okay. Now quarrying, mining, photography, baking. Baking except factory. They already put there as exemption there. Bakery cannot lah. But if you have a factory like secret recipe, can. Clear? Not clear? Okay. Water treatment, petroleum, timber, photocopying. Okay. All of this are excluded from the idea of manufacturing. Can? Okay. Next one. Agricultural entities. Okay. There are some agricultural entities that are acceptable. Farmer associations. You got fishermen association, agro-based cooperative companies or citizen and individual can claim. Who carries out a proof agriculture project as a qualifying project for purpose of modernization, automation, diversification, expansion? As long as it fulfills this MADE, can see this word, MADE, modernize, automate, diversify, expansion, you can claim. So, qualifying capital expenditure for agricultural entity includes clearing and preparing land. Remember, whatever they spend here can be classified for RA. Will be part of the qualifying capital expenditure QCE for the 60%. Planting of crops, provision of irrigation, provision of plant machinery, construction of road, building for staff. So remember here, building for staff allowed, previously not allowed. Okay, under manufacturing not allowed, for agriculture allowed. Okay, activities that are allowed include the following: maize, rice, fruits, tuber cultivation, livestock, except chicken and duck. Okay, that one is excluded. Aquaculture, anything approved by the minister. Okay, are we okay this part? No, any one cukup. No need to do all, just one. The project must be within the scope of MADE. Either your scope is modernization, diversification, automate, or you are going to expand your business, expand, make it bigger. Okay, are we okay in this part? Can, huh? Right, let's move on. Okay, let's have a look at questions here. Look at this question, see whether you can answer this one. So we're looking at Apex first. Apex makes shoes and makes a claim for RA in 2001 in relation to diversification of products. Say the period covered by the RA. How long? Okay.
This one is given to the company, right?
Yeah.
If the first year the company do diversification and then the next 3 years if automation cannot get that.
Can.
Can get.
Can.
Even the same in the same business.
Yeah, once you gain the RA already, you can already. The RA is open to you.
Oh, okay.
As long as your project fall into the 4 category, you can claim. Not that you have to diversify. You as long as within the 4 category, you can claim. So that means you claim first diversification, then after that you do automation, claim again lah. Then you claim extension, claim again lah.
But it falls into the same like the income, right? The same income.
Yeah. Okay. It can be different projects. No, it doesn't go like that. Once you claim RA, the RA is open to you for 15 years for the company. Within the 15 years, you can do whatever project, claim. You got it already. No, it's on already. Not you got it. It's you on the clock. Clock running already. Once your clock 15 years finish, habis. Might be able to extend another 3 years. But within the 15 years, you can do any projects. Jumping projects is okay. Not that you have to continuously do the same project. Any projects within the MADE. Okay, I can any projects. Can, huh? So as long as you buy QCE and you implement, then you can claim. Follow?
Even though not less than the project is not as in 15 years.
The project can be in 1 year, 2 years, it doesn't matter. It's the clock starts for 15 years. Okay, are we okay this part now? Can, huh? Okay, now, Scotts, remember, undertook an expansion project in 2000 after it incorporated in 1996. It claimed a RA made for new machines under hire purchase that had 3 equal installments. It then carried out another expansion project in 2005 by buying a machine for 5 years hire purchase with equal installment. Explain the position of 2 projects under RA. Can? Follow? If the calculation is same as ITA, I don't want to waste time with the calculation with this thing again. We'll practice more during the revision, alright? Can? Any questions? Follow? Okay, let's move on. Now, the next one here is Destro makes a claim for 300,000 year of assessment 2014, qualifying for a qualifying project with expansion purpose with respect of new machinery costing 500,000, which is 60% lah. In year of assessment 2016, the company decided to put the machine for sale since the project had failed. Board had classified the machine as held for sale under IFRS. Discuss treatment of RA. By the way, you see the questions here. The questions are not supposed to be hard. So remember, in text, there's only two types of question. Yes, no, reason, and compute. How? Like, if I ask you Pioneer, compute. How? Do the calculation, show me, finish. They won't ask you to explain too much. The exam question won't ask you to explain the computation. So far, the examiner has never done that. Okay? Compute, how, plus, how to treat this? This one treated like this because of this. Treated like this because of this. That's all. Got it? So the answers are supposed to be straight and give logic on it. This examiner doesn't want you to beat around the bush, doesn't want you to write too much theory and all that. Because you end up writing theory, you might actually write too much theory. According to the examiner, she says like, when she asks group relief, everybody write every condition they know about group relief and never answer the question. In other words, they show off their memory lah. They shoot there. The answer, the application is very little. She says she doesn't want so much. She just want, okay, group relief, can. This is a reason, finish. So it's most of the time, remember the answer for the paper is always yes, no, why, finish. Or finish. You don't need to go too much. Cannot. Yes, can claim because of this reason. No, cannot claim because of this reason. You just have to remember the why. The why means you have to refer to the, okay, remember the why is either that's it. Either a principle or a rule. What's your principles you're using to justify the why? Yes, can. These are the principles. These are the reasons. Just give your reasons. Principle means quote the principles. You use badges of trade. List down the badges of trade you use. Don't list every badges of trade. And you don't need to tell the examiner, I'm using badges of trade. The market doesn't really need to know. Because they are talking at professional level. When you go talk to your client, you don't go and tell the client, I'm using badges of trade. This one cannot, can. They just want that. So they want you to behave like at work. Does that make sense? So get straight to the point. The examiner is very particular on that. She said, I want you to talk like talking to client. Okay, Okay. Destro, the classification. Got a little bit of theory. What's the theory? Held for sale equals deemed disposed. Finish. Got it? Can I move on? Okay, next one. So earlier I talked about proportionate, right? Remember proportionate charging? Company locates its factory to a new factory, this is the one, new factory, so that they can take up a qualifying project. The cost of new factory is 6 million, total area of new factory is 500,000 square meters. The old factory is 20,000 square meters. Calculate the amount they qualify for RA. How much? Proportionate. How much is the new factory? 6 million, right? Can you claim everything? How much is it then going to claim? Is it 3.6k? No. 3.6k, right? Okay, done. This is the one I talked about earlier on, remember? Prorate, yes or not? Can, cannot. All okay? Can I move on? Can. Okay, so we're done with this one. This is a table for you to see comparison, so you can review this comparison, alright? This is a comparative table between Pioneer Status, ITA and RA, alright? Right, I'm just going to go to agriculture first. I think agriculture, most of the things are covered already. The one I want to cover is this one, hotel and tourism. Hotel and tourism, the main one you have to know is Pioneer Status ITA apply to hotel tourism to range of gazetted promoted activities. So Pioneer and ITA will apply to a range of projects. Does that make sense? It covers agriculture, it covers hotel tourism. Hotel tourism, you get the following products. Okay, establishment of medium low cost tourist hotel up to 3 star, not 4 star. Okay, expansion or modernization of existing hotel, establishment of tourist project. Okay, what's a tourist project? Tourist project is like the one you find in Malacca, where they have that funny, on the way to Malacca. Sentosa, is it Famosa? Famosa, that would be considered a tourist project lah. Clear? I do not know whether Sunway Lagoon would fall under a tourist project. I think it should. Okay, but it's a huge loss anyway. Right now, expansion, modernization of tourist projects. an establishment of convention centers. Now you know why people like to build convention centers, which no one wants to use. Okay, now, except for location and relocation promoted areas covered later, rates applicable to hotel tourism are those that apply to manufacturing. For pioneer status, 30% is deemed part total income. The allowance is 60%, so exactly same. For hotels, the capital expenditure specified as a qualifying for ITA consists of you construct hotel building approved in of the approved standard in Malaysia, include alteration, extension, renovation, or provision of plant, machinery, or other facilities used in connection to hotel. Now, I am suspicious of hotel business. The examiner may want to ask about hotel. Clear? She might talk about somebody setting up a hotel. She already asked somebody setting up a college before. Clear? Okay. For tourism, the following capital expenditure is accepted. Okay. This one I think I went through earlier already. All right. Okay. So most of this are acceptable. Now I'm coming to export incentive. So in terms of the three incentive, let me repeat one simple point for you. You need to know this table. Okay. You need to know this table. You need to know the rules I just talked about here. Simple rules here. Got it? For RA, it's important to know the boxes. I've done it in box format. Actually, this is the most simplified version of the notes already. Are you clear or not? Okay? These are more the wordy versions. The ones that you see here are called the wordy versions. Can? So, just use this. You should be enough already. Alright? This one. Then, for calculation, I think you know how to calculate. It is the same as ITA. Conditions for qualifying for RA is important. You should memorize this one. Alright? This is quite important. After that, for investment tax allowance, nothing much. There's no other mechanics, no the basic rules of it, 70% and mutually exclusive. Got it? Pioneer status is the one that you need to spend a bit of time for capital allowance rules, loss rules, the leapfrog rules. You know, they jump all the way down. Those rules, you need to know the three rules. Pioneer status being the most hardest of them all within the world of incentives. Got it? Can. Okay. The next one that you have is going to be called export incentive. Now, export incentive you can build into any business that does export. And you can talk about export of manufactured goods and services and agricultural produce, or you can talk about export of services. Export of manufactured goods and services, you got exemption for income for increased export. This one there's increase export. Whenever you increase the export, you can get some money or some incentive. This incentive is, you got one called the Malaysian International Trading Company, which is down here. Then you got the next one down there, which is this one. Allowance for increased export. That's AIE. Are you clear or not? Allowance for increased export. There's a special one for motor vehicle and parts. Are you clear? There's a special one for motor vehicle and parts. Then you got enhanced incentive for export. EIE. Enhanced incentive for export. Okay. They are all the same, just the percentage only run. I repeat, they are all the same, only thing changing is the percentage. Okay. Are you clear or not clear? The percentage here, okay, I'm just going to go through the first one. Incentive aim to encourage development growth of large Malaysian trading companies. Malaysian international trading companies. Company approved by Malaysian International Trading Company is eligible for this tax incentive. Must be approved. Keyword. This one, unlike RA, must get approval. Eligibility must produce letter for Matrade. Matrade must certify you that this is the condition lah. Company incorporated in Malaysia. 60% issued share capital owned by Malaysians. Annual sales of more than 10 million. Not more than 20% of sales from trade of commodity. Your sales cannot have 20% from commodity. Limit is 20%. Are you okay? Okay. Company users must use local services for banking, finance and all that. Exemption. This is the exemption you get. This is the incentive. The incentive is in a tax exemption. The tax exemption is, an MITC is eligible for tax exemption of 20% of value of increased export. Okay, restricted to 70% of statutory income for the year of assessment. The incentive period, okay, MITC is eligible for tax exemption for 5 consecutive years. So, same as the other ones, 5 year. Okay, beginning from the years of assessment when they first qualified for exemption. Now, there are a few ideas here you need to know. Number one, for the purpose of this incentive, export sales means sales derived from export of local imported goods commodities but does not include trading commission and profit from trade at commodity exchange or sales to free industrial zones, licensed manufacturing. So there are some excluded from the term export. Value of increased export means the difference between free on board value of goods and the commodities exported in the basis period. Okay, and that of the immediately preceding period. So you must have a record of your sales. Can? Okay. Carry forward, if any amount determined to be exempted, it's not absorbed because of restriction to 70% of statutory income in absence of statutory income. Such amount can be carried forward to be given to MITC in the first subsequent year of assessment which there is statutory income for the business. Keyword, first subsequent year. That means you cannot keep on carrying forward. You cannot say, I don't want to claim. You must claim when it's available. Does that make sense? You must claim when it's available to be claimed. Cannot push. Understand what I mean? I cannot push. Cannot say, I don't want to claim this year, I push to next year. Okay. Two-tier exempt account and exempt dividend. Don't worry about this one. You know why not? Dividend nowadays, everything is exempted already. Alright? Okay. Incentive encourage companies presently engaged in trading of commodities to diversify into trading of goods as they would like the requisite volume of export to start with. However, such companies must be mindful that it must keep export of commodities to minimum of 20% of sales revenue. No, there is no exclusion of specific agricultural produce for MITC incentive. RM 10 million threshold render MITC status within reach of many companies. Okay. A trading company set up within a group to export goods manufactured by related companies is eligible for MITC. So you can set up a special company just to do overseas sales. That's one of the technique to acquire this one. So what you might have is a company might have a single this one, then you might separate it out and have this one separately. Clear? Okay. Now, there is no mutual exclusion with other incentives. There is no mutual exclusion to other incentives. This is quite important to understand. Huh? Okay, that means can you claim both? Can. Remember, can. Can you claim like Pioneer and this one? Yes, you can. Follow? Okay. So, example, have a calculation on this one. Singer's number is the MITC has achieved the qualification required for income tax to qualify for tax exemption. It has following information. Value of expat at fee or board and statutory income. Calculate chargeable income after tax exemption. Explain impact if chargeable income was only 0.9. Okay. Look at this. How much is the increase? Allowance is going to be how many percent is this? Well, be careful. The limit here is how much? 20% of the value of increased export. Yes or not? Correct? Okay, so the allowance is going to be 20% times increased export how much? 6 million, therefore giving you 900,000. No, how much is it? 1.2 million. Okay, so if we talk about this one, what's going to happen? If the statutory income is allowance is going to be 3.6 times 70%, giving you how much? 2.5 versus 2.1. Is it 2.5? Yeah, 70% at 3.6. 2.5. So this one going to become. Are you okay in this part? So what do you get here now? This one's going to be is 1.2 versus 1.2, where I get 2.16. So you should get 2 point. Okay, done. Now, if the is 900K, the is 630K only, right? Yes or not? With balance of 570K being okay. Are you okay in this part? Follow? Can, huh? Now, you see this allowance here, right? The way we are doing this allowance, right? It's exactly the same for the others. The only difference is percentage going to change. This one is going to be based on, well, 20% of the increase in export. The rest are almost the same. Okay, let's go through this. So the next one that you have is this one. Let me just walk through this one. Tax incentive for increased export for manufactured good and agricultural good. Allowance for increased export. Got it? Same idea, increased export. This is to promote increase for resident company that's engaged in manufacturing or agriculture, exporting manufactured products or agricultural products. Incentive. Okay, this one, special one. Exempt 10% of value of increased export for goods exported to achieve 30% value add. So you have to prove your value add. Okay. Exempt 15% for increased export provided goods achieve 50% value add. Okay. They did give a benefit for SME. SME, the value add is 20% and 40%, lower threshold. Are you okay in this part? Same calculation. So if it's a 15%, 30%, 50%, you put here you'll calculate what? 10% times 6 million, 15%, that's all. The same number will go down. Are you okay or not? No, the SME means they need to only achieve lower threshold, 20% only value add. They don't need to achieve 30%. They got this benefit already. Clear? Not clear? This one is 40%. They give discount a bit for SME. Alright? Exemption statutory income is equivalent to 10%. Remember, this one is 10% for agriculture. This is for manufacturer. Manufacturer got value add. Agriculture got no value add. Flat 10%. Because agriculture, just take your durian and sell. Clear? So your durian, you don't need to add value. Follow, don't follow? Okay. The above exemption of statutory income is restricted to 70%. Can be carried forward. Okay. The amount utilized is credited to tax-exempt account for which tax-free dividends can be done. Mutually exclusive. This incentive is mutually exclusive to other incentive. Okay, does that make sense? This one is mutually exclusive. MITC is not. MITC not, this one is. Okay. Exclusion. Okay, this is exclusion. Tin, ingot, slabs, tin ore, rubber, natural rubber latex, natural gum, copra, all this out. Crude palm oil companies also out. Kernel cakes and all that. Okay. Log, saw, timber, natural sheets, premium oil. Okay, all of this is excluded. I don't think your examiner will ask you exclusion list. All right, just for awareness. Incentive period. There is no finite period for AIE. A company may qualify for the incentive as long as requisite conditions are met. Does that make sense? That means there's no limit. Once you meet, you meet lah. Okay, the point is you have to keep on increasing your foreign sales lah. Your foreign sales stabilize already, where you're going to claim anything. Okay, clear? They're like, go on, export. We give you, but you have to keep on going on with your export growth. Remember, it is for the value of increased export. Okay? Not for your export.
This one I need to get approval, is it?
This one no. Okay. Now the next one you got there is the next one is this special case: exemption for income for significant increase in export, penetration of new market, or export excellence award. These are three special conditions on top of the AIE. On top of AIE, okay. This is to encourage Malaysian company to strive for not just increase but significant increase in export, manufacture high quality goods. So to be able to penetrate new market, must be locally owned. Okay, remember, must be locally owned resident manufacturer, agriculture company incorporated in Malaysia, at least 60% Malaysian owned, are eligible for special enhanced incentive for allowance for increased export. Got it? Okay. So export sales is defined here. Now the classification is quite simple. If, remember, all of it's still the same, value of increased export. Does that make sense? So this is all about if a company can achieve a value of increased export. They can, and they can see achieve significant increase in export, whereby value of increased export in the company at least 50%. You increase more than 50%, you can claim 30%. Clear? Then succeed in penetrating new market. List of export markets determined by Martrade. They have given a list here. You can claim 50% of your increased export. Then you achieve maybe Export Excellence Award or Brand Award. You can get 100%. Okay. Are we clear this part? Now, if you get A, you cannot get B and C. Okay. Same restriction 70%. Exempt account, two-tier accounts. You need to maintain separate account. Incentive is mutually exclusive. Are you okay? Once you get one, you cannot get the other one. Okay, any questions there? Can, exclusion of goods exported under this incentive, same thing. Whatever that was excluded earlier on is also excluded here. Okay, are we okay there? Right, motor vehicle, remember I told you motor vehicle got special case, right? If you open a motor vehicle company or you sell car like, Proton or Perdua and all that, or some companies that sell car parts, as long as they are exporting, they get special benefit. Okay, theirs, the rate is higher. See, exemption of statutory income, remember earlier on was 10 and 15%, remember? So it was 10, so you had 20%, 10%, 15%, 30%, 50%, 100%, yes or not? You have to memorize that numbers. Make a note. You need to memorize that numbers, because you need to know which percentage apply to which situation. So this one got a bit of issues in memory work. This one got memory work. She's not going to tell you. She expects you to know. Are you okay or not? But it's not so bad. It's just certain rates. Okay? Motor vehicle, 30-50. Follow. If your value add is 30%, you claim 30%. If your value add is 50%, you claim 50%. That's it. Okay. After that, you got double deductions for promotions. I think I will cover this during revision time. Okay. I might have to cover this during revision. Double deductions for promotions and double deduction for export of services. I'll probably give in one top-up class at the back there. Alright? Because this is a bit longer than my anticipation, because I added this one recently only. I modified this chapter recently only. Okay, never mind, I'll be able to complete this by the first class of revision, that's for sure. And we will practice questions on this one only. Yes? Never mind, don't worry, I'll post that on the internet. Okay, any questions? Okay, I will stop there for today. Any questions? Okay, by the way, finish the questions. Okay, there are a few things you have to do. Finish questions on the system. Have you been doing questions on the system? Yes, no. No, no, or normally it will trigger a result that you will. Okay, finish the question and finish the test. There's tests on the system. Are you okay? I suggest you start with the test. The test will make sure you get demotivated to the maximum. Are you okay now? After you go through the test, you find out like you don't know anything actually because you haven't studied anything. You probably get hit like maybe 30%, 20%, but if you just go blindly into the test, you'll find out it's very hard. Yes, no? Objective only, right? Very hard. Objective only, you can close your eyes and do tembak only, A, B, C, D. Soalan panjang, right? Yes, I know, the questions are a bit tricky. Have you tried it already? Which one, the test You macam tekan yet Read only I suggest you start. Or you want me to do it like a game, Then I'll tell you I'll play the game on this day. I'm thinking of doing game, there's a game where everybody join in and then I shoot the questions out very fast. Kahoot. You want me to do it that way? Then I challenge you all and see who can go faster. That one fun, Okay. Alright. I will see you on next week. I need to compress this note one more time. My incentive note, I made it bigger recently. Now I have to go compress it back again. Bye-bye.